We are exactly 12 hours into the new year. It is January 1st, 2026, and a financial countdown is underway that most Americans are not watching. While families were celebrating midnight across the United States, something seismic happened in Beijing. China's export licensing system for silver officially went live at midnight Eastern Time. That means right now, as I'm speaking to you, 121 million ounces of annual refined silver exports have been slammed behind government gatekeepers with no guarantee they will ever reach Western shores. But here's what they are not telling you. Russia triggered this chain reaction months ago. Ladies and gentlemen, I'm bringing you an emergency broadcast today because Moscow's silver accumulation program is not just about stockpiling a shiny metal. It is a calculated attack on American industrial supremacy and your purchasing power. And the evidence is stacking up so fast that even the mainstream is starting to panic. This is your warning from Capital Key. Look at what unfolded in the last 72 hours. Silver touched an all-time high of 84.01 per ounce on Monday morning, before collapsing 11% in a single session, the worst crash since September 2020. But here is what nobody's explaining. That was not natural market behavior. That was forced liquidation. The CME Group raised initial margin requirements on silver futures twice in 6 days. First spike from $22,000 per contract to $25,000 on December 29th, a brutal 13.6% hike. Then they did it again on December 31st, forcing traders to post even more cash to stay in the game. Do the math with me. If you are a retail trader holding 10 contracts of March 2026 silver, you just got slapped with a $250,000 margin call in the final week of the year. Small funds without liquidity got crushed. Forced selling. Panic exits. But that is not the end of the story. Russia knew this was coming. Moscow has been positioning for this exact moment since mid-2025, and now their strategy is raising red flags across every corner of American finance, national security, and global trade. Let me take you back 14 months. In November 2024, Russia's finance ministry publicly announced a 3-year plan to allocate 51.5 billion rubles per year across 2025, 2026, and 2027, exclusively for strategic precious metals, silver, platinum, and palladium. That is $535 million in hard currency earmarked for non-gold metals. But here's the kicker. Russia became the first and only central bank in modern history to formally add silver to its official reserves. Not gold, silver. Central banks do not touch silver, ever. Gold is the reserve standard. But Moscow broke the playbook. Why? Because they understood something Washington refuses to admit. Silver is no longer just money. It is the choke point for the entire fourth industrial revolution. Solar panels, electric vehicles, 5G infrastructure, semiconductors, AI data centers, military radar systems, missile guidance, every single one of these technologies requires silver. Industrial silver demand hit 36,000 metric tons in 2024. And global mine supply? Stuck at around 26,000 metric tons. We have been running a structural deficit for 5 consecutive years. That gap is not closing. Russia looked at that math and said, if we corner even a fraction of this market, we can destabilize the entire Western supply chain. And that is exactly what they are doing. Now watch how the dominoes are falling. Russia announces their silver plan in late 2024. By September 2025, silver prices break above 42 per ounce on momentum triggered explicitly by Moscow, BS entry into the market. Analysts at major banks start writing urgent memos. Russia's silver accumulation is a watershed moment. Then, in November 2025, something even more alarming happens. Russia, Boreas Central Bank, begins selling its gold reserves for the first time ever to fund budget operations and prop up the ruble. Moscow is liquidating gold, the asset they have been hoarding for a decade, while simultaneously buying silver. Let that sink in. They are rotating out of the traditional reserve asset into the industrial warfare metal. That is not portfolio rebalancing, that is weaponization. And the timing could not be more precise. Because just as Russia locked in their silver strategy, Beijing watched and said, we control the refining. China refines between 60 and 70% of the world's silver. They take raw ore from mines in Peru, Mexico, Australia, and process it into bars and industrial-grade material. If China decides to throttle exports, the entire Western world is cut off. So in late 2024, Beijing quietly drafts an export licensing scheme for silver, tungsten, and antimony, 3 metals that are absolutely critical for defense contractors and tech manufacturing. The announcement drops in mid-2025. Effective date, January 1st, 2026. And here we are. As of this morning, only 44 companies have been granted licenses to export silver from China over the next 2 years. 44 companies controlling 121 million ounces per year of flow into global markets. The rest, trapped inside Chinese borders. Elon Musk tweeted 2 days ago, "This is not good. Silver is needed in many industrial processes. Even he sees it. Tesla relies on silver for battery contacts and electronics. If Chinese supply dries up, production lines freeze. But it gets worse. Russia is not just buying silver. They are also planning to ban gold bar exports starting in 2026 to curb capital flight and retain strategic resources. Moscow is locking down every ounce of monetary metal inside their borders. So now you have Russia accumulating silver and blocking gold outflows, China licensing silver exports, and Western markets suddenly realizing we do not control the physical supply anymore. The entire pricing mechanism is fracturing in real time. Let me show you the three realities that exist right now in the silver market, because this is where it gets dangerous. Reality number one, COMEX paper silver in New York. As of this morning, silver futures for January 2026 are trading around $70.50 per ounce after yesterday's brutal sell-off. That is the official price you will see on Bloomberg terminals and financial news tickers. But that price is determined by leveraged speculators and algorithmic traders pushing paper contracts back and forth with no intention of ever taking delivery. The registered silver, the actual metal available for delivery at COMEX, peaked at 530 million ounces earlier in 2025. But then, something terrifying started happening. In the first 4 trading days of December 2025 alone, more than 60% of all registered silver was claimed for physical delivery. That triggered what insiders are calling a liquidity death spiral. Eligible silver, metal sitting in vaults but not designated for delivery, started converting to registered and then immediately draining out. January 2026. Delivery contracts hit record open interest levels for a minor month. Translation. An unprecedented number of traders are demanding the actual metal instead of rolling their contracts forward. COMEX is being raided from the inside. And the CME's response? Margin hikes to crush demand. Classic suppression. But the physical market is screaming a totally different story. Reality number 2, London LBMA, physical silver. The London Bullion Market Association runs the largest over-the-counter physical silver market on the planet. For decades, it operated smoothly with tight spreads and instant settlement. But in mid-2025, everything broke. The LBMA went into delivery default for months at a time. Multi-month delays became the norm. Buyers placing orders in May were told, "We will get you your silver in September." That is not a market. That is rationing. And the reason is simple. There is no metal. LBMA vaults source their inventory heavily from China. When Beijing announced export restrictions, the flow into London started choking. Silver lease rates, the cost to borrow physical metal for short-term delivery, exploded to record highs, surpassing levels not seen since the Hunt brothers squeeze in 1980. When lease rates spike like that, it means one thing. Nobody wants to lend their silver because they know they might not get it back. Banks and refiners are hoarding. The paper price in New York says $70, but in London, if you want actual delivery within 90 days, you're paying premiums of $8 to $12 per ounce over spot. That is a 16% premium on a $70 base. The market is no longer unified. It is shattered into jurisdictions with completely different pricing. Reality number 3, Chinese domestic physical silver. This is the bombshell that mainstream media will not touch. Inside China, retail silver prices surged to $100 per ounce equivalent in late December 2025. Let me repeat that. While COMEX futures were trading at $74 before the margin-induced crash, Chinese buyers on the street were paying $100. Why? Because they know what is coming. Chinese citizens understand that once the export licenses kick in, domestic supply will be locked inside the country and international buyers will be completely cut off. So wealthy Chinese families, retail investors, and industrial hoarders are panic buying every ounce they can find. The $100 price is not speculation. It is fear. The Chinese government controls the refining, but they cannot control domestic panic. And that panic is a direct result of Russia's strategic blueprint. Moscow showed the world that silver is not just a commodity. It is leverage. It is a choke chain on the neck of Western industry. And Beijing is pulling that chain tight. Now let us talk about what is happening beneath the surface in the COMEX vaults, because this is where the endgame starts to crystallize. Total silver inventories across all COMEX-approved warehouses stood at roughly 530 million ounces at their peak in early 2025. But as of late December, that number has collapsed below 420 million ounces. That is a drawdown of over 110 million ounces in less than 12 months. Where did it go? Some went to industrial users, desperate to secure supply ahead of Chinese restrictions. Some went to sovereign buyers like Russia, stockpiling strategic reserves. But a significant portion went to wealthy families and institutions who are pulling metal out of the system entirely and storing it in private vaults outside the COMEX network. They are taking it off the board. When you withdraw silver from registered status, it means that metal is no longer available to settle futures contracts. The COMEX relies on a fractional reserve system. They issue far more paper contracts than they have physical metal to back them. It works as long as most traders settle in cash or roll their positions forward. But when a critical mass of traders starts demanding delivery, the whole structure collapses, and we are watching that collapse unfold in slow motion. Look at what happened in January 2026 delivery month so far. There are still more than 2,200 contracts outstanding representing 11 million ounces that have not been delivered. That is not normal. Delivery months are supposed to settle cleanly, but whispers are circulating on trading floors that major short sellers, banks like Citigroup, are struggling to source the metal. If they cannot deliver, they will be forced to default or negotiate cash settlements at massive premiums. When defaults start happening, confidence in the paper market evaporates. And that is when the real repricing begins. Russia knows this. That is why they positioned early. They are not trying to make money on a trade. They are trying to break the pricing mechanism itself. Now, let me connect this to the broader geopolitical chessboard because Russia-ORS silver strategy is not happening in a vacuum. This is economic warfare coordinated across multiple fronts. Russia controls massive natural gas supplies to Europe. They dominate palladium and platinum exports, critical for catalytic converters. They are the fifth largest gold holder in the world with 2,236 metric tons as of November 2025. And now they are cornering silver in partnership with China's refining monopoly. What does that give them? The ability to turn off the lights on Western industrial production whenever they choose. If you are a defense contractor building next-generation missile systems, you need silver. If you are a solar panel manufacturer trying to meet green energy mandates, you need silver. If you are an automaker electrifying your fleet, you need silver. Russia and China now control whether you get that silver. And if Washington pushes too hard on sanctions, tariffs, or military aid to Ukraine, Moscow and Beijing can simply stop the flow. No bombs, no tanks. Just a quiet supply cutoff that grinds the entire Western economy to a halt. And the United States is asleep at the wheel. There is no strategic silver reserve. None. The national defense stockpile has some legacy silver, but it is a fraction of annual industrial demand, and much of it has been sold off over the decades. Meanwhile, domestic silver mining in the US is almost non-existent as a primary source. Most American silver comes as a byproduct of copper, lead, and zinc mining. We cannot ramp production quickly, even if we wanted to. We are import dependent. And our two biggest import sources are Mexico and Canada, both of which send their ore to China for refining. Do you see the trap? Even if we mine it in our own hemisphere, it flows to China to get processed, and then maybe flows back to us if Beijing grants a license. That is not supply chain security. That is vassalage. Let us talk about what happens next, because I want you to understand the phases of this crisis as they unfold. Phase 1, the fracture. That is where we are right now. Paper prices in New York are detaching from physical prices in London and Shanghai. Premiums are exploding. Delivery delays are stretching into quarters instead of weeks. This phase is characterized by confusion. Retail investors see the COMEX price and think silver is correcting after a big run, but insiders are scrambling to lock in physical metal at any premium because they know what is coming. Phase 2, the squeeze. This happens when COMEX registered inventories fall below 300 million ounces, and major short sellers cannot source metal to deliver against their contracts. Defaults will be announced quietly at first, settled with cash premiums and non-disclosure agreements. But eventually the news will leak, a major bullion bank will fail to deliver, and that is when trust in the paper market collapses. Futures trading volume will crater. Open interest will plummet. Traders will flee to physical-only platforms. The paper suppression game will be over. Phase 3, the repricing. This is when Western governments and industries realize they are in a full-blown supply crisis. Silver premiums will not be $12 over spot. They will be $50 over spot. Official COMEX prices might say $85, but if you want delivery within a month, you are paying $135. Governments will try to intervene. Emergency import deals with secondary producers. Strategic partnerships with allied mining companies in Australia and Peru. But it will take years to reroute supply chains that have been optimized through China for decades. In the meantime, industries will have to choose, pay the premium or shut down production.